Financial markets have been consumed by all things political into 2018, and this has left very little opportunity for anything to be moving on the more traditional fundamental drivers. But it's also important to highlight a critical pattern break that has happened over the past several months, which ultimately could result in more price action like what we've seen in the latter half of this week with risk correlated assets. From the onset of the financial markets crisis right up into 2017, the pattern was a pattern in which the Fed would issue its forward guidance, the market would disagree, and the Fed would acquiesce. But in 2017, the Fed finally showed that it was capable of holding to its word, which meant it was the market that was all of a sudden doing the acquiescing. If that's the case, and this is how it's going to be, we believe it's going to be very important to pay attention to developments like the ones seen this week, in which the Fed was out sticking to its more hawkish leaning guns, and the market reacted accordingly, selling off on fear of what might be in a world where buying stocks is no longer a free money play, and those valuations are all of a sudden not looking all that attractive. At this stage in the game, stocks have yet to really roll over like we believe they will, but given this critical shift in the balance between the Fed and market, the possibility that this next dip may not be bought back seems to be a possibility that needs to be taken a lot more seriously. As far as today's calendar goes, key standouts come in the form of German factory orders and producer prices, Swiss CPI, Canada employment, and the always closely watched U.S. jobs report. Earlier today, Aussie retail sales came in better than forecast. That's all for now.